The wheel strategy is a fantastic strategy that I use to keep cash injections in my account. Once I put my initial amount in my account, I don't add any money to it. I use it on my little high yield dividend account here and on my big main account. And I want to show you the benefits of using the wheel strategy and how to do it, like to functionally do it. This is Mike, the tactical stock scalper. All right. Let's kind of get into the basics of how to generate consistent returns with the wheel strategy and what it's all about. Okay, as you see here, guys, it is a really powerful options trading strategy, and it allows you to profit from a single stock in various different ways. It really has a lower risk and definitely a higher profitability than most other option trading strategies out there. Okay? If you're a buy and hold type person, like we are with these high yield dividend funds, adding the wheel strategy to your tool belt, guys, is just a fantastic way to generate money. Okay, so let's kind of talk about how it works. The wheel strategy is a systematic way to sell option cash secure puts and cover calls in a long-term trading methodology. So what does that mean? Okay, the first rule, okay, and I need to stress this to you guys. The first rule of trading cash secure puts is you have to want to own that stock in case you get assigned. We're going to get all into that here in a little bit. But that rule is number one, rule number two, rule number three, and so on. The most important thing with the wheel strategies, you have to want to own that stock. If you don't like that stock and you're just trying to get premium, don't do it. You will get assigned and you'll hate yourself for it. You have to want the stock. Okay. In essence, you keep selling options on stocks that you're bullish on, stocks that you want to own to generate monthly income. Now, I generate daily and weekly income with mine, and I'll show you how I do that. Here's a methodology behind it. Look, you sell a cash secured put, okay, options on a stock, and then you get assigned for it sometimes. Sometimes you don't. Sometimes you just keep collecting premium because the stock never goes that low, okay? But if you do get assigned, then you sell a covered call on the assigned stock until it, goes up to that strike, and then you get your shares called away, and you do it all over again. You just repeat it. That's why it's called the wheel. Okay, so now that we got a basic understanding and you've seen a lot of this gibberish, go to thewheelstrategy.com. It is a great website. I'm not sponsored by them. I'm not sponsored by anybody. I do these videos for free. So if you like my videos, please caress the like button. Okay. Let's go here. Here's my balance history. As you see, clearly I'm outperforming the market month over month. Okay, so the stock that I like to use for this little account is TSLL. Okay, this is one of my favorites to run the wheel on. I run it on my main account and on this account. So the reason I choose TSLL is because it's very volatile. Okay, it's a Tesla stock. It follows Tesla, and it moves 1.5 times the rate of Tesla. So it goes up and down rather quickly, which is great for running the wheel strategy, and it means there's a lot of volatility associated with it. Let's check out the chart of TSLL. Okay, so we look at the chart, and it's just like Tesla's, except at a much smaller price tag, of course, okay? But it's just like Tesla's. It moves up and down just like it. Here it is on a daily today. And as you see, it goes up, it goes down, just like Tesla does, okay? So this is how you run the wheel strategy. You go to TSLL, as this is my example because I love to own this stock, and I've owned it many, many times. You go over to your option chain. On the left side are the calls. In the middle is the strike, where you want to sell your put at, okay? And on the right side are the puts. If you wanted to sell one today, okay, 0 days to expiration, if you can see that there, that means this thing is going to expire basically in an hour. So that's why the premiums on the put side are really low. 13.23, if you were to sell it now, you wouldn't make very much, right? So let's go out. And what I do is I sell mine weekly. Here's a couple things to this. You need to have the money in your account in case you get assigned. So let's start with the 1273 strike that you see there in the middle. If you were to place this option and to sell it, your thinking would be, okay, I don't think it's going to get below 1273, okay, by next Friday. But you have to be okay with it if it does. Like I said, the number one rule is you have to want to own the stock. Because if it dips below 1273, okay, you will be assigned those shares at that price. Even if it drops to $10, you would still have to buy those shares at $12.73. So that is $1,273 if you were to sell it at the strike price. Okay. So you would have to have that money in your account, and you can't touch it until the option is expired. So if you were to sell one contract, which is 100 shares, okay, you would get $18 to $20 right now. So let's click on it. Okay. You could put a limit order in for 20 and hope you get picked up, okay? Or you can market order it and just get the $18. Now, some brokers charge you to make option trades, so you need to find that out. But this is the information here. As we see, 7 days till expiration, so it's a weekly, okay? It'll show you the previous open and close for the last couple days. The day range, it's moved $10 in a day. That's pretty nice movement for Tesla really not doing much today, okay? The implied volatility is there if you want to look at it. And there are the Greeks. Now, we could do an hour-long video on the Greeks. I would recommend that you go look at the Greeks and study them. But the number one thing you need to know about it is theta. But honestly, because I've ran this so much, I don't even look at the Greeks. I know exactly what it's going to do. Theta is just the time decay. And when you're selling options, you want them to expire worthless so you can collect the most amount of premium. And that's what theta does. It shows you how fast they decay. Okay. So we're going to go here, and we're going to go ahead and hit trade. Actually, we'll go back to the options chain. There we go. So you would make $18 or $20 if you did this right now, today. Not bad for one contract. Then let's just say you get assigned. Let's say it goes to 1271 and you get assigned and you buy those shares at 1273, which is going to happen automatically. So we'll go out a week past that. Okay? You got assigned at 1273. What you would do then, you could do a couple different things. You would sell a call, maybe for 1323, and you would make $100 off of that. Plus, you see there on the left side where it says 101 to 105. So we'll just say $100. You would make $100 off of that call, in addition to the share price appreciation and the money you originally made from selling the put. So as you can see, you can really rack up and generate money rather quickly. Now, there's a couple different ways to work this. Let's say you don't want to be assigned, and the stock continues to go up or whatever. You can buy to close these and collect the money. It might not be 100% of it, but you could collect 50%, and that's what I typically look for. I look to close mine about 50%, 50 to 60%, and then I do another cash secured put or covered call. I just like to create the revenue continuously from selling options. And I take that money and I buy shares with it on my high yield dividend funds. So we could make this video much, much longer. I just wanted to give you a basic primary instruction on how to sell cash secured puts and covered calls. If you like this content and you want to see a much longer explanation and much more detailed, please drop it in the comments and let me know. I'll be happy to do that. But this is just a basic overview. This is Mike, the Tactical Stock Scalper, out.